Gilt are issued by the UK government when they borrow money. Rather than pop into a bank to borrow money, the banks go to institutional lenders and they sell what are called gilts. Gilts are issued in £100 segments, and each gilt will pay a fixed rate of interest for its term. For example, if you buy a 10-year gilt and interest rates are approximately 5% at the time you buy it, then you'll get £5 a year as interest. At the end of 10 years, you'll get your £100 back. And that sounds a relatively straightforward and simple investment. But if interest rates were to rise to say 10% and you wanted to sell your gilt after 12 months, then the person buying it would be wanting 10% per annum as an income. As your gilt only pays £5 a year, that would be a difference of £5 per year in interest, or £45 over 9 years. So they would offer you something approximate £55 for your gilt. At this moment in time, interest rates are really, really low, and the price of gilts is really high. It's driven not only by interest rates, but also by the fact that the last few years banks have been doing quantitative easing, which basically means they've been buying gilts and other bonds, which pushes the price up further. And also there's very little liquidity in the bond market. The bond market is also concerned currently with the price of oil being so low. The oil price has an effect because in the US, many of the companies mining shale or drilling for shale are highly geared. In other words, they borrowed an awful lot of money. And all that will be issued in junk bonds in the US. With the price of oil as it is, many of them are possible will default, which could cause a problem. Interest rates, at some point the cycle will turn, interest rates will rise, in which case we would expect the price of gilts and bonds to fall. And therefore, as an investment, it's something which we tread very carefully and watch extremely carefully.